Yeah, so June 11th, like that's going to kick off the like central bank policy meeting, week. They all condense right in with each other. So we're going to see ECB, BOJ, Fed with the first Warsh era
It's gonna be a big one. Yep.
FOMC meeting coming up. But what markets are showing here, and the article is just referencing June 11th for the ECB meeting. It's basically a lock for a hike in short-term euro area, euro denominated interest rates. So, and then in the longer term, like for the rest of 2026, swaps markets are now pricing in um, up like three hikes. So in 25 basis points increments, starting right now from the policy corridor at 2 to 2.25%. We're looking at by end of year in the euros money markets, 2.75 to 3%. Right. So huge development here. I'll talk about the backdrop this is taking place into, but what it actually reflects in the ECB. My opinion for this, it's hawkish weakness, right? You're hawkish on rates, right, up, but the underlying economic backdrop, it's in a condition of weakness. So I'll get into what I mean by that. But the starting point, the smoking gun, Cameron, is the slide, the 4-week T-bill, what we talked about. So we've been calling this out. No one else is talking about this to my degree. It's just very lightly covered. But that Memorial Day rip, that rush into the 4-week Treasury bill while U.S. markets were closed, brought the 1-month T-bill rate from our policy corridors range of 3.7, inside that the Fed's current 3.5 to 3.75 band, brought it in 80 bips. So that is telling you in real terms, in dollar denominated terms, roughly 2.8 or 80 bips lower than the US money markets, what they can support. That's the level of dollar denominated growth that these other developed market financial systems who are non-producers of commodities can actually support. So what do I mean by that? So this 4-week T-bill chart, if I had to give it a name, if it's hanging in a art gallery somewhere, as it probably should be, I'd title this thing "Drowning Man Gasp for Air." Like that's the way I view this, and I'll briefly explain what I mean. So when we commenced Epic Fury on February 28th, what that did is it put the entire world into this state where the music shut off in the game of musical chairs. Everybody scrambled for the limited amount of commodity resources that were available at that given time. And with Hormuz offline, say there's 10 chairs, one of them got pulled away. Like you're talking about a reduction in global energy supplies from like 105 million barrels per day down to 95. So one chair gone, everybody's fighting, 12 people are fighting over 9 chairs is kind of what it amounts to. Um, all right, so that commodity shock forced all of these non-energy producing developed market economies to scramble for dollars. So say Japanese yen, for example, you sell yen, you buy dollars. That puts the dollar into a consolidation in terms of like a longer term weakness as the dollar is weakening, as the underlying primary trend. Um, and like ultimately, we hit a point though where those higher commodity prices just naturally choke off incremental demand. This makes sense. Like at some point, you're paying too much for inputs. What do you get? Well, you get reduced demand for borrowing, reduced demand for growth as private sector just naturally responds to higher prices with delaying plans or canceling plans, right? Um, so, I mean, we're doing it in the US too. So, for example, summer vacations, if say you're at jet fuel prices where they were prior to Feb 27th, hey, maybe you were going to take that first class ticket from New York to Australia or whatever, wherever for your summer vacation. Well, if jet fuel prices rise, what are you going to do? Well, you're going to substitute into something else. Well, instead, we're going to get in the SUV and go to the Adirondacks or whatever. Everybody's making that same decision. Um, all right. So what that did is in FX markets now, you've got, there's a supply of currency out there, a supply of savings in the financial system. And what that reduced demand does is it puts the balance between supply of money and demand for money into a state of like excess savings that works its way out through the exchange rates. And ultimately, what it does is it winds up in the dollar, and you see it here. That bid for dollars, that drowning man gasping for air, is the excess money supply from that imbalance working its way into New York and DC. All right. So the direction of liquidity flows is into New York or the US banking system. And then we won't talk about this much, but that torque is like it shows up in risk assets where, all right, equity markets up since April 7th. And the the one thing that's the apple of everybody's eye right now, the AI build out, that's when you just get this massive torque into those assets that
Yeah.
Mr. Market is scrambling. He's like, I want this at any price, is almost like where his head is at. All right. So what that means, like, all right, that also materializes. Cameron, if you go to slide 6, remember back at the December 2025 meeting where the Fed officially announced this was the end of QT. We're moving into a balance sheet expansion era, but they didn't call it QE. They called it reserve management
RMPs.
purchases,
Yep.
where they're going to now buy Treasury bills onto the Federal Reserve's balance sheet, right? And you see it, it starts picking up right at that December 15th meeting. If you just, this is the weekly reported holdings of U.S. Treasury bills at the Federal Reserve. And you can see the yellow line here up until April 7th. You're looking at an annualized growth rate of almost 900% over the course of the year, which is like, all right, the Fed would monetize the federal deficits. That we talked about this, or we have talked about this before in prior episodes, but the maturity profile, just the dynamics of this current era, this backdrop we're going through, that maturity profile of the Treasury's debt outstanding, it wants to shrink, right? And you're moving more and more of that funding concentration lower and lower over time. All right. Key thing happened here. Talk about this liquidity flow that the Hormuz situation created, and that the commodity price impulse that then rolled over as everybody scrambles, and that effect translates into reduced growth in developed markets for the non-energy producers, which of the DMs, right? It's pretty much everybody except for the United States.
Right.
And that translates those dollars coming in. You can see it in the growth rate of this RMP curve, right? You see it's still up, but it's a bend, right? So instead of a 900% annualized growth rate, now you're at like 100%. Still massive growth, right? It's still going to amount to like, hundreds of billions of dollars over the course of this year. But the
Right.
key thing is we've entered in an environment now where it's a battle of attrition, and it's all about who breaks first. And the underlying backdrop that's been created by pressing the issue on Venezuela, Hormuz, part of this, like epic fury is just the kinetic side of the action. There's a capital war taking place as like the twin on that other plane. What this is showing, so that effect in the Eurozone, they have to hike rates, and I'll get into what that means in just a second. We're going to talk about the German yield and the slope of the German bond and the slope of the yield curve. But what this actually effectively means, everything going on in this underlying dynamic in Iran and everywhere else, as this theater is more than just Iran. It's Venezuela, it's Cuba, it's everywhere, everything all at once. That kink is showing you like this is buying us extra runway. And then on the opposite end of that, it's a zero-sum game at this point. Who blinks first? That forces the issue on someone else, and that is the ECB. Hiking first into economic weakness is blinking in this game. All right, so talk about the German yield. So what you're trying to do, if you're dealing with an environment, so let's say your banking system in Frankfurt or Paris or whatever on the European continent, you've got this reduction coming through, expressing itself in the private sector, reducing its demand for borrowing. That is leading to currency flowing out of your system over to New York, is the direction of travel. What you actually have to do to counter that is increase money supply to like bring extra savings into your money markets.
You need to entice
So
that though, right? Yeah.
yes, exactly. So if you hike rates, what you're doing is, hey, German worker or for whoever, Italian worker, save your greater share of your paycheck in our euro, bank deposits, money market account, all that stuff. Buy buy euro sovereign debt. And what you're actually doing on the other side of that, so that's raising rates on the short end. And then what you want to do is flatten the yield curve, because if you let the yield curve positively slope, what you're actually doing is incentivizing credit expansion inside of your, sovereign's financial
You need to
system.
tamp that
And
down
it
somehow.
and that borrowing will create money. But your signal here, the underlying backdrop, this inflation you're addressing is actually due to rising prices, which is coming out of not money printing, it's the access to marketing and
Energy. Yep.
distribution of those commodities, right? Supply demand relationships. All right. So what you do here is you want to put a lid on the long term, like 10-year, 30-year boons, uh, and then allow that short end. Market has said, yeah, you're going to have to hike. So that's going to come up. Let's say right now we're saying going from 2 to 2.5 up to 2.75 to 3. Right now, there's a battle taking place at like 3%. You can see it in the German yield on this chart. I've got the whites for like an intermediate range and then those yellows for the highs and the lows. We're battling it out right now as we speak for that blue region. Um, if you're Christine Lagarde, you really want to defend the boon here at this 3% level. What you do not want to see is the return to the sovereign debt long end hiccup, where long end yields want to rise. Because ultimately, then to get that inversion you want in your yield curve, pull more money, more savings into your financial system, it gets more and more costly to do so. You'll have to hike
Keep
further.
hiking more.
Uh,
Yeah.
so the difference here between 2022 and 2026, the hallmarks are very similar actually, and I'm surprised more people haven't picked up on thinking of it this way. But think about Putin's invasion into Ukraine in 2022. What did that do? Oh, it created the same thing, a commodity squeeze. Oil goes to 120. Gold makes its second attempt at the $2,000 level. Very similar this time around on the geopolitical event, the false breakout. Gold runs at the $5,000 level, fails. The difference here is in 2022, the Fed was coming off of ZERP, and it was forced into that position because we had a Democratic Congress and White House that passed fiscal stimulus like the American Rescue Plan and the Infrastructure Investment and Jobs Act that forced the Fed to maintain rates at zero to fund this thing. Um, and then when that inflation or when the geopolitical event created that same thing we saw with Epic Fury, pulling out the chair in the game of musical chairs as everybody scrambled, the Fed was the one on the back foot and they had to normalize the yield curve. And then we got into this massive, historical inversion in both like magnitude and length to work itself out. Now, the difference here is the underlying strength of the U.S. economy. We have productive resources. So getting through this little pickle in 2022 versus 2026, the check has been passed now. In my thinking, it's on very clearly on the ECB here to react, and you can see that, in my opinion, in reporting from outlets like the FT. So you see this ECB says as the key statement in this headline, gold replaces US Treasuries as world's top reserve asset. So you present this as like a position of strength. It's like, look, we're de-dollarizing. Look at us. This is actually, so if you take the framing that what DC and New York are actually pushing is this transition from $1 to the other. We're moving from an offshore liability definition of the global dollar system towards an asset-based dollar definition, which is this stablecoin dollar thing. We'll talk about it in a second. Um, the natural effect as we're pulling off, like we're drying up that old world, that euro dollar, the offshore dollar system, you can't just run that same game of forcing the treasury into print, like just going deeper and deeper into debt, which then winds up on offshore balance sheets, et cetera. Now, SOFR being the key thing here, the marginal dollar in the system in New York was like the key linchpin of getting us to this dynamic. So now that in 2026, when this very similar playbook to what happened in 2022 arises in the short-term dollar credit and liquidity cycle, the shoes are on a different foot. I guess
Yeah.
is how I would frame it if I'm using that phrase, if that makes sense. All right, and so understanding what the FT is writing about here, like obviously gold is now your reserve asset instead of tapping into this offshore dollar treasury liquidity pool, and there's still some of that going on. This is still a sizable market. We're midway in that transition from the old dollar to the new dollar. So that market is still there, but gold has now become like your liquidity cesspool for the dollars you need as we get into this tightness in the cycle. All right, and so you can see that in our article. We write about this on the Mindprint Hash blog. Call it the offshore dollars being left out to dry. If you want to read that further, but this is exactly, if like for our house view of this framework, everything we're talking about now, the US has passed the buck to the Eurozone. They're going to be the ones who have to invert their yield curve. To do that, you have to have the strength in your underlying economy that the activity holds up, and then that output, that production, is there to provide those savings into the euro money markets in the first place. And that's where we're going to get the same thing. The same way the dollar is shifting from that offshore liability driven standard towards this stablecoin asset based dollar. Euro's going to have to figure something out along those same lines. We'll see what they roll out here with this digital euro project. But we won't go deep on this here because it'll take a long time. But that there's a totally different framework between the standpoint of what the U.S. is going down with Besant within with a private sector issuance of this asset-based dollar versus a public-focused issuance with your what the ECB really wants to do. It looks like with a like CBDC type of public dollar, which at the end of the day would still be a liability definition. So we'll continue to watch that story, but big developments here, and I think ECB with the lock-in for June 11th. It's I mean, there are only death and taxes as guarantees in this life, but markets are pricing it in.